Welcome back. You're still watching Business Lunch. Now, the insurance regulatory body, the IRDAI, has released a draft paper to regulate ownership as well as investment norms in insurance companies. So, Yash is here to bring us up to speed with the details. Hi, Yash.
Well, that's correct, Pavitra. So, as far as the draft paper from IRDAI is concerned, it deals with three important aspects. One is what would be the regulations when it comes to starting a new insurance company? How would the promoters be subjected to regulations? Second one is the promoter or the investor lock-in at different stages of that insurance company. And then third one is private equity investments. What regulations would they be subjected when it comes to exit in these insurance companies? I'll start with a lock-in for promoters or investors. Once you start the company, you receive the business license, there will be a 5-year lock-in for promoters. Lock-in if invested within 5 years of business commencement. In that case, the lock-in would be for either for 5 years or 8 years from the grant of business certificate to the insurance company, whichever out of the two comes earlier. The next one, when it comes to lock-in for promoters, when the amount is invested after 5 years but before 10 years, in that case for promoters, the lock-in would remain either for 3 years or for 12 years after the company received its business license, whichever comes earlier. For investors, it will be earlier of 2 years or 1 year from the grant of business license. Finally, if the amount is invested after 10 years of business commencement, in that case, the promoters will have a lock-in of 2 years, investors will have a lock-in of 1 year. As far as the private equity investments are concerned, there are important things which have come here also. As far as private equity investments which are eligible to invest in insurance companies are concerned, they should have completed 10 years of operations. Funds raised by that private equity fund should have been more than $500 million. Investable fund with that private equity company should have been more than $100 million. And finally, the private equity fund should have invested in the financial sector in any jurisdiction. But importantly, there was a condition earlier where private equity investments had to happen through an SPV route. That has no mention in these draft regulations.
All right, Yash, thanks so much for getting us all those important details from the